All right, this is day 10. Starting work a little bit later on today. Very tired in the morning, but starting it now. Just got back from work, and yeah, day 10 right now. I'm trying to get like 4 hours in. Got the coffee. This one's bitter. I go like bitter. It's bitter as hell, but let's see if it works. I'm about to get into it right now. So day 10. Yeah.
Round 1.
All right. I just finished work block 8. And what I learned was currency crosses. And if you do not know what currency crosses are currency pairs that do not involve USD. Major pairs are called, no, major pairs are pairs that do involve the USD. Example of a major pair is USD CAD, USD JPY, GBP USD, NZD USD. Pairs that involve the USD, in it, are called majors. And currency pairs or currency crosses are pairs that do not involve USD. Example: JBP, JPY, NZD, CAD, CAD, JPY, JPY, NZD. All these pairs that do not involve the USD in it are pairs that are currency cross pairs or currency crosses. The most popular currency cross pair is the EUR-JPY. Yeah. Also, the reason you should try trading currency crosses is because it has less spikes in the market. With pairs that involve USD, they are more susceptible to having strikes in it. Not strikes, spikes. Goddamn. They are more susceptible to having spikes in it. And what I mean by spikes is, let's say example, you see prices in an uptrend or whatever, and then the Federal Reserve comes out with some news that then has USD just drop. It is a huge spike going downwards. for the USD. This will mess up your whole trade, and now you think that price could be in a reversal when it actually isn't. It's just that the Federal Reserve came up with some news and then you mess up your whole pair. But with currency cross pairs, they are way less susceptible to spikes in price because they don't have any USD pairs involved with it, you know. Yeah, so that's why it's good to trade currency crosses. You don't have to trade currency crosses, but they are a good option. So let's say you hop onto your chart and you don't see any good patterns, or you don't see a good opportunity for you to get into the market for today. So you say, you know what, let me go to currency cross, and you're gonna see way more opportunities for yourself. So yeah, you don't have to stay with majors, although most traders stay with majors. You don't have to stay with majors. You could also trade the currency crosses as well to also broaden yourself for more opportunities. Yeah. Another thing that I learned was that currency crosses are more trendy. And what I mean by that is, let's say in a 3-day, actually no, let's say a 20-day span, price is, let's say a USD JPY pair is doing this. It's going up, but it's going up like this. Slowly going up. But with a EUR JPY pair in that same 20-day span, price will be doing this. So with currency crosses, they move smoother. They move way smoother than USD pairs. So that's another thing. If you want to trade currency crosses, it's another reason why it's better than major pairs. Another reason why you should trade currency crosses is because, let's say you are a trend follower trader, a trader that uses trend following as a strategy. It'll be easier for you to catch more pips if price is moving smoother to the upside rather than just doing this. You'll catch way more pips at a faster time frame if price is going straight up. So yeah, that's another reason why you should trade currency crosses, and that's another thing that I learned. Another thing that I learned was trading interest rate differentials. And what I mean by that is, let's say you have a pair that you know for a fact the base pair interest rate is way stronger than the quote pair's interest rate. So you say, you know what? Since I know this in mind, since I'm a smart trader, I'm gonna do a long trade on that pair, because you know for a fact that the base currency is stronger than the quote currency. So you would as I said before, you would then place a long trade on that pair. That is something that I learned. Yeah. Another thing is, although some currency cross pairs are like really good, like EUR JPY, there are some that are very choppy and volatile. Like those weird pairs that like let's say, as a couple, I have a couple here: AUD CHF, AUD NZD, CAD CHF, or GBP CHF. Those pairs are very volatile and very choppy. You can be in a trade that has those pairs, and you think, okay, I'm good or whatever, and there's a really bad spike, or like price just moving like this, up and down. So it's very hard to get into those trades, especially if you are a breakout trader. If you are a breakout trader, you would have to have wider stop losses to be able to get into those charts and actually be able to make a good profit in those charts. So yeah, that's how you would be able to trade obscure currency crosses, but they are way riskier than EUR CHF, like stuff like that. Not EUR CHF, EUR JPY. Yeah. Another thing I learned is how to trade fundamentals with currency crosses, and how you do this is this way. Let's say news comes out about EUR, not EUR, USD. Let's say the Federal Reserve says they're gonna be raising an interest rate for USD. Which is really good. This is saying that the economic for the economic for the United States is doing really well. But let's say at the same time the UK does the exact same thing. The UK's economic is strong as well. You're not gonna trade USD against EUR or EUR against USD, because the price will just be stagnant. The price will just be doing this, just ranging up and down. What you can do instead is you take EUR or USD and trade it against a pair that has a less or a weaker economic or a weaker interest rate. Example, you could trade EUR against, let's say, CAD, or you could trade USD against JPY, EUR against JPY, because you know JPY has a less interest rate or a weaker interest rate or a weaker economic rate. So yeah, that's how you could trade fundamentals with currency crosses. You take a stronger pair or a stronger currency. If you know that currency will definitely be stronger, and you trade it against a weaker currency. So how you'll do that is this: you would say, I know that EUR USD will be going up, so I'm gonna trade it long against EUR or USD against a weaker currency that you know is way weaker than EUR or USD. So yeah, that's how you could trade fundamental analysis with currency crosses. Another thing I learned about was synthetic currency pairs. What synthetic currency pairs are like this. Example, let's say a institutional trader are traders like the banks, the ones that have massive amounts of money, way more than retail traders. Yeah, so let's say an institutional trader wants to buy, let's say, GBP JPY, but there isn't enough liquidity in that market right now, in that chart right now. So what that institutional trader can do is this: it can take GBP USD and USD JPY, since those are the leg currency pairs to GBP JPY. They offer more liquidity. What you do is like this: the institutional trader will then buy GBP USD and sell USD JPY, which then creates GBP JPY. It's a synthetic pair, but the thing with that is you now have higher margins because you have two different trades, and now you have less money to trade with because you have two open trades now. And also it's higher. It's a higher spread because you're trading two different pairs. Although you cancel them out and make it into one synthetic pair, which is the GBP JPY at the end of the triangle. Yeah, you have to pay more. You have to pay more spreads. Maybe have a higher margin on all type of stuff because you're having two different trades open, and if you don't have a lot of money in your account, it makes it harder for yourself. So that's how institutional traders trade synthetic pairs, and yeah, that's it. Oh, also, if as a retail trader, we wouldn't be trading synthetic pairs. It's only if you have a large amount of money, and the pair that you want to trade in has a low liquidity. That's the only reason you would trade synthetic pairs. But other than that, you would not be trading synthetic pairs. Yeah. All right. Another thing that I learned is how to use currency crosses to trade the majors. And how you can do that is like this. Let's say you have one pair, EUR USD, and you have another pair, GBP USD, and on both those pairs you see a buy signal. But let's say you don't want to take both those buy signals. You only want to take the best buy signal out of those two pairs. What you can do is this. You could search up EUR GBP against each other. You could go onto that chart and then see what price is doing for EUR GBP. If you see that price is going downwards, you could then say that GBP is stronger than EUR. But if you see price going upwards, you could then say EUR is stronger than GBP. So I'm gonna do it for the example where if the price is going downwards for EUR GBP. So if price is going downwards for EUR GBP, you can then say that okay, GBP is definitely stronger than EUR right now. So then I will go back to my initial two pairs and I will say, you know what? I am going to do a buy for GBP USD. Since I went to the EUR GBP pair and seen that GBP was bringing EUR downwards. So yeah, that's how you could trade. That's how you could use currency crosses to trade majors. Okay, this one, the last thing that I learned was the title of it is how cross currency pairs affect dollar pairs. I'm gonna be honest, I understand it, but I do not know how to explain it. But I'm gonna try to explain it to the best of my capabilities. So let's say the Federal Reserve comes out with something saying how they raise the interest rate of USD. You're like, you as a trader, you're saying, okay, bet this is an easy play. Now I'm gonna just do a buy for USD. So you're like, okay, you know what? I see a EUR USD pair. I'm gonna do a buy. So you make, let's say, 100 pips on that. But your friend who did USD, the JPY, made 200 pips on that play. And you aren't understanding why your friend made more pips than you on their trade. So the reason for that is because on the USD JPY chart, let's say there is a resistance level, right? And let's say when price breaks through that resistance level acts as a stop loss for a lot of traders. And when that stop loss gets hit and it breaks through, a lot of breakout traders now says, okay, I'm gonna hop on that trend and place a buy, pushing the price way higher for the USD JPY pair. Yeah, for the USD JPY pair. But for the EUR USD pair, all right, so since buying more USD JPY weakens the yen, that means for a EUR JPY pair, the EUR would be way stronger than the JPY. And since the EUR and JPY chart, the EUR breaks through its resistance level, that means the JPY is really, really, really weak. That means the EUR is also very, very strong. So if you do the EUR against the USD, the price wouldn't drop as much because the EUR is still strong. But if you were to do the USD and JPY, the price would rise way, way, way higher because the JPY is already weak. But if it was USD EUR, and it would rise slower because the EUR is also a little bit stronger than the JPY. So yeah, I tried to explain to the best of my capabilities. I think I messed up a little bit or a lot, but yeah, that's how it works. And that is what I learned for work block A. I'm about to chill for like 5 minutes, and then I'm going to get into work block B. Oh, and I also just finished grade 13 for high school. I finished grade 9, grade 10, 11, and 12 already, and 13. So right now I only have grade 14 left, and then I'll be going on to college and then university. So yeah, I'll see you guys soon for work block B. All right, got my food. I'm gonna get into work block B right now. Let's get into it. All right, so I ain't gonna lie, I didn't work yet. I ate my food first, chill for a little bit, and now I'm about to get back into it still. So yeah, better get back into 2-hour work session, work block B. Time right now is 11:21 p.m. I should be done by like 1:30. You 121? Yeah, I should be done by 121. So yeah, let's get into it right now.
Round 2.
Alright, so I just finished work block B. So, with work block B, before I start, I don't know what happened. I don't know for what reason, but I am awake right now. I don't know if it was because of the coffee. That coffee, I used a different type of coffee today, and it was very bitter. Right? I ain't gonna lie, it was bitter. I could really drink it. I could only drink half of the glass and threw the rest away because it was so bitter, bro. I don't know if that's a reason. Although I'm yawning and everything, like I feel awake. I'm awake right now. Like, I'm not tired whatsoever. Like, yeah, I'm okay right now. I'm pretty good. But yeah, getting into work block B. Another thing, I hope that for my other sessions, like tomorrow and stuff like that, I have this level of awakeness. That'd be perfect. That would be so good. But yeah, let's get into it now. So for work block B, what I learned was multiple time frame analysis. Now, for the multiple time frame analysis, what it is like this. Let's say you are a trader that usually trades on, let's say, the 15-minute time frame, right? You being a trader that only trades on a 15-minute time frame is not good. You should not be doing that, because let's say you see a potential sell signal. So you're like, okay, let me get into that sell signal now, right? But as soon as you get in, price goes up, and you're not understanding why. I'm like, you seen your signal, and your signal looks so perfect. There's no way this could go wrong, and if for some reason it goes the opposite way, that's because you only looked at the 15-minute chart. But if you had zoomed out and looked at the bigger picture, you would have seen that price was actually in a uptrend channel. And when the price is in the uptrend channel, when you see that sell signal, it was because price reached its support level and was about to reverse and go back up. But you didn't see that because you were only looking at your 15-minute chart and not your 30-minute or 1 hour chart, which would have saved you until you should be doing a buy signal instead of a sell signal. So yeah, that's what I learned for how to trade using multiple time frame analysis. That's the first thing. Now for the second thing, what time frame should I trade? To figure out what time frame you should trade, it depends on personality, because some traders may say the 15-minute is too fast for me, I either trade the 1 hour, or some traders may say the 1 hour is way too fast, I rather trade the 4 hour. So it's honestly up to your personality and whatever you want to trade. And how you figure out how or which time frame is the best for you is demo trading. Demo trade and see which time frame suits you the best. See which one you are more comfortable with. See which one you can analyze price the best, and therefore and so on. And yeah. All right. Next thing I learned was what time frame is best for trading. Well, it honestly depends on what kind of trader you are. If you are a trader that likes to that is okay with waiting a long period of time for the trade to hit or whatever the case may be, you would be better as a long-term trader. Again, this is all with personality. Whatever trader you feel you are most comfortable being, that is the type of trader you are. All right, continuing to what I was saying. If you are a trader that likes to trade, let's say the 4 hour time frame, and is okay with waiting a week for the trade to hit, then you are a swing trader. And if you are a trader that's okay with being on a 15-minute time frame, seeing the price move a lot, and you're okay with it being like that, then you're okay with being an entry day trader or a scalper. With all these different trading styles, they all come with their advantages and disadvantages. Example, like the long term trading. You don't have to watch the markets every single day. You don't have to watch the markets. You can just place your trade and just kind of leave it for like a month or months and wait for your trade to hit. But you'll only be like doing like 2 trades per year, and it's kind of boring. No, see, that's not my for my personality. But yeah, that's you'll be waiting for like you'll only be doing like 2 trades per year. For a short term or swing trader type of trader, um there's more opportunities for you to trade, less chance of losing months, less reliance on 1 or 2 trades a year to make money. And the disadvantage is the transaction costs will be higher, more spreads to pay, overnight risk. And overnight risk becomes a major factor because you'll be holding your trade for like days or weeks. Next thing is entry day trading or scalping. With entry day traders, there's lots of trading opportunities, less chance of losing months overnight risk, as with short term or swing trading. And the disadvantage will be transaction costs will be much higher, more spreads to pay, and it'll be mentally more difficult due to the need to change your biases frequently. Yeah, yeah. And profits are limited by needing to exit at the end of the day, because you see with long-term traders, you can hold a trade for a long time. You could just see a price go from here all the way here in a couple of months. But with a entry day trader or a scalper, you can only hold price from here to here until the day closes. So until the day finishes. So yeah, as the disadvantages and advantages of the different types of entry day trading styles. Yeah. Again, you would only know what type of trader you are based off your personality. There's no perfect entry there's no perfect trading style for anybody. Just as I said before, it's just based on your personality. There's no one perfect trading style. Yeah. All right, so the next thing that I learned was how to use multiple time frame analysis to find better entry and exit points. So with this, what I learned was that, let's say you are a trader that trades on the 15-minute time frame. Okay, so you're in the 15-minute time frame. You then go to your 1 hour time frame to see what kind of market it is, like, or the market sentiment, if you're in an uptrend or a downtrend. Okay, so you see your support and resistance levels on your 1 hour time frame. You then go back to your 15-minute time frame, and you say, okay, now you know where the support and resistance levels are. You know where to buy or you know where to exit. But then before you even enter your trade, you go onto your 10-minute or your 5-minute time frame, and then you see, okay, let me now try my best to get a better entry. Instead of me seeing on a 15-minute time frame, let me get on a 5 or 10-minute time frame to get a better entry or a better exit, then go back to my 15-minute time frame so I can play a little bit safer. So yeah, that's how to trade multiple different time frames, or yeah, multiple time frames. And the last thing that I learned was trading with 3 different time frames. It's basically the same thing that I said before. If you are a trader that's using a 15-minute time frame, you go to the 1 hour time frame to see what the market is doing. You then go back to the 15-minute time frame to mark out your buy or your sell plays, and you go to the 10 or 5 minute time frame to get into the trend earlier. That's how you use the 3 minute time frame. It helps you get into the trend earlier and get out later, so you can get more pips, and also helps you to know when to get out before everybody else gets out in a way, because most traders only use a 15-minute time frame, and that messes them up a lot. And the longer time frame, like the 1 hour, 2 hour time frames, helps you to know what the market is actually doing, so you don't get finessed. Okay, so yeah, that is what I learned for work block B. And also I just finished the high school level of baby pips. I'm gonna show you right now. Hold on. All right, yeah, so you see I just finished high school right here, man. Finished a lot already. Finished a lot. You finished 215 out of 372 courses. Yeah, W. So yeah, finished all of this already. Now I already finished high school. Now I'm doing undergraduate freshman. Well, college basically. Yeah, college or university. I think it's college. Yeah, I think it's college. Yeah. So yeah, again, I just finished work block B, and soon I'm about to finish the whole of the baby pips course. And as I said, my challenge for myself right now is I cannot get a haircut until I finish the baby pips course, and I'm almost done. And as you guys can see, my head top is really mosh right now. It's really messed up, you know. So I have to do, I think, 4 or 5 more, 4 more on courses in baby pips until I can get a haircut. So yep, that's it for day 10. I think it's day 10. I'm gonna say day 10. Hold on. Yep, that's it for day 10. Day 10, I was right. Yeah, so you know, I'm gonna see you guys for day 11. We're doing pretty good right now. So this is my second 4-hour day in a row. We're doing pretty good. Pretty good. Yeah. Although I did it a little bit later on, at least I did 4 hours. At least I did 4 hours. So yeah, that's pretty good. And yeah, I'm gonna see you guys for day 11. And let's hope we can keep the streak going. And then next week, I'm gonna be doing 5 hours. So yeah. Oh yeah.